I want to set the stage for what I think is going to happen in 2024. So one, we expect mortgage rates are going to fall slightly. And that's kind of the general consensus. We expect home rates are going to go up slightly, modestly. I'm sorry, Crash Bros, we don't see the crash. 3, we kind of expect rates, prices, and household incomes, that to be working together to make housing about 5% more affordable by the end of 2024. So if rates get a little better and prices are calm and people's income goes up slightly like it does every year, housing should be more affordable towards the latter part of 2024. Also, we gotta full disclosure, forecasting is fake. So everyone that makes a forecast, we're all making a guess. I'm making guesses, these economists are making guesses, these major financial institutions are making guesses. Hey, comment your guess. Are we gonna be in the 8s? We're gonna be in the 10s? We're gonna be in the 7s, the 6s, the 5s. Where are interest rates going? Because right now, no one knows. And as we go through this, you're gonna see that a lot of these major financial institutions, they're just all over the board. We gotta bring back in the lock-in effect. So according to Freddie Mac, 2/3 of all homeowners in the United States have a rate below 4% right now. That's gonna keep supply really, really tight. If rates drop a bunch, that'll maybe unlock some of that supply, but that doesn't look like it's going to happen. Also, 92% of all mortgages are under 6%, so below where we're at today. Lastly, we have to talk about what the Fed is actually concerned about. So the Fed is concerned about what is known as real interest rates. Real interest rates is where we take the nominal interest rate minus the rate of inflation. That is how the Federal Reserve will shrink or grow our economy. The Fed funds rate today is about 5.5%. Fed's favorite metric, PCE, is 3.5%. So you take 5.5% minus 3.5%, you have these real interest rates of about 2%, which the Fed has called sufficiently restrictive. So that 2% is restrictive. So naturally, the thing to be thinking about is we know inflation is trending what? Up or down now?
Going down, supposedly.
It's going down. Yeah, we're not feeling it in our pocketbooks, but inflation is definitely trending down. So if inflation continues to trend down, that means next year we could foresee a time where we would be at, let's say, 2.5 for the rate of inflation versus the 3.5 today. So if you take the Fed's fund rate of 5.5 minus that 2.5%, that gives us a real rate of 3%, which would be more restrictive. So if the economy is already contracting, and we know inflation's going down, it makes logical sense that the Fed is therefore going to reduce the Fed's fund rate while still being restrictive, while still being higher for longer, causing the economy to continue to slow down even while rates are decreasing. If you are getting value out of this, please hit that subscribe button and connect with us. As you can see, with that, the market is projecting in right now up to 100 basis points cut because of that reason. If inflation goes from 3.5 to 2.5, the Fed could naturally cut 1% next year in order to get lower interest rates. What are your thoughts?
It's interesting what you said about how forecasts are shit, basically. It's just unpredictable because wars, geopolitics, so many variables. But then my question was, how far into the future can you predict accurately? And what are the things that you look at? Because one thing I really respect about you is you look at the data.
Yep.
So short term, you have a pretty good feel. I had the most random thought. I was like, forecasts are unpredictable. Nobody can truly predict it. Why does the Fed even make announcements about what they may or may not do or what they're doing, their explanations? Why don't they literally just put out a number and say, this is the number this month?
Because one of their major tools that they use to control us is their mouth, is their language, is the messaging they're conveying. That's why they hold so many press conferences. They kick the number out there, and then they can go and say, that number's horrible, or that number's the best number ever, and that influences the stock market to actually do something afterwards. It influences the whole economy and influences other countries. So the Fed's going to always use their mouthpiece as a major tool for good and for bad to influence what's happening. You asked the question, where or how far can we predict? With rates, we can't predict where they're going even on a daily basis because they're so volatile. They move up and down all the time. We just saw that rates were just over 8%, and then then boom, all of a sudden we're back to like 7.2. That happened because of what the Fed said, because of devaluing of the dollar, and that happened because the market was feeling like the Fed was done raising. So that caused that natural collapse in about 1% to happen, and that happened in less than 30 days. We use data for stuff that are controllable variables, looking at long-term things like the number of building permits being built, the number of development applications going in, population trends, jobs, things like that. We're looking at housing supply, number of new listings, prices. So we can get a really tight feel for the local market. That's good for, 30 days to sometimes as long as 6 months. But, the national economy or major geopolitical events and interest rates are like off the table because we don't have any control over them, and they're going to move much faster. So we're looking at slower moving data, which we can see kind of moving like an iceberg, iceberg dead ahead, and it's just click, 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 versus interest rates, they dropped 1% in a month. Smash the like button, hit subscribe. Thank you for watching. If you enjoyed this video, watch this one too.